Hey everybody, Smart Silver Stacker here. So we got the CPI numbers for December from the Bureau of Labor Statistics earlier this morning, and this is just going to be kind of a quick video. I'm going to give you my take on the numbers and a brief overview on what we saw. So overall, the CPI declined 0.1% month over month, so a small drop in prices from November to December, but that doesn't really tell us the whole picture. Now, year over year, we still have an inflation rate of 6.5%, and most notably here, the core CPI was still up 0.3%. See, a lot of the decline in the prices that we saw in December had to do with energy falling. The energy index decreased by 4.5% over the month. Food was up, but if you exclude both of those things, you just take the core, that's still 0.3% increase. And that's pretty notable because if you annualize that, it gives you a number about 3.6%. That's still well above the Fed's target inflation rate of 2%. And that decline in energy may be somewhat short-lived. There's a number of factors at play right now that indicate that we may be seeing higher energy prices as we move forward here in 2023. Notably, the reopening of the Chinese economy following their strict COVID lockdowns. This is a headline from yesterday from Bloomberg. Goldman Sachs sees $110 oil by the third quarter of 2023 on the full China reopening. And certainly, a resurgence of economic activity and manufacturing in China will lead to a much higher demand for oil. I've heard some estimates that a full reopening may lead to as much as a additional 1 million barrels per day being consumed by the Chinese economy. So I don't think this is too far off base. Now let's take a look at the markets. First of all, this is Yahoo Finance. So we get the main headline here. Consumer prices fall 0.1% in December, and inflation cools for the sixth straight month. And that is sort of the mainstream narrative here, that prices are falling. But I don't know that that really paints an accurate picture of what's going on. We'll talk about why in just a moment. But first, let's just take a look at the broader market indexes here. The S&P 500, the Dow, and the NASDAQ all pretty much flat on the day at the moment, some with minor gains, some with a small loss like the NASDAQ here. Now, initially, all of these indexes were higher on the release of this news ahead of the market open. But then markets opened, everything kind of fell into the red, now pretty much flat on the day. Moving on to the metals, you've got gold here. Take a look at the one-day chart, and you can see that gold actually kind of liked this news, spiked up to $1,900 on the release, but we have given up most of those gains, kind of fell down there at market open, and now rebounding a little bit, but still doing considerably better than the main stock indexes. And then silver, same story. Had a spike up over $24 on the release of this CPI data, but now given up some of those gains, but still up more than 1%. So overall, this news was good news for silver. And I didn't mention earlier, but CPI at 6.5%, that fell right in the middle of analyst expectations. Analysts were expecting a rise year over year of inflation from somewhere from 6.3% to 6.8%. So 6.5 was right in line with expectations. Now, one of the drivers of the market action that we have seen following this release of the CPI data is related to the anticipation of what the Fed is going to be doing at their February FOMC meeting. And we take a look at the CME FedWatch tool here, and you can see that following that announcement, the probability now that is being calculated of a 50 basis point rate hike is only at 7.8%. And most market participants are anticipating a 25 basis point rate hike now in February. So with inflation being in line with expectations, it seems that investors believe the Fed is going to slow down the pace of their rate hikes even further, and hence some of the positive action that we saw in stocks on the immediate release of this data, and I believe also the positive action that we are seeing in the precious metals market. Now, Zero Hedge had an interesting breakdown here. Notably, I just want to draw your attention to this one chart that showed that goods inflation did tumble. If you take a look a little bit deeper into the data, the services inflation is actually at the highest level since September 1982. So not all prices are falling evenly across the board. And notably, the big driver of inflation here, I believe, moving forward, will be this continued incredibly loose fiscal policy by the government. I mean, tremendous amounts of spending. You can see the national debt about to hit $31.5 trillion with no end in sight. The federal budget deficit approaching $1.5 trillion now. So I don't believe that even if we do see some small drops in prices, especially in volatile categories such as energy, that means the inflation problem is over by any means. Now, what the Fed does, that's another matter, because I don't think the Fed ultimately is going to remain committed to their inflation fight in light of weakening economic data that we are likely to get moving forward in 2023. And really, any significant drop in prices that we see at this point doesn't have to do with the contraction of the money supply, as you can see. I mean, the amount of borrowing and spending is unabated, but American consumers are really starting to get squeezed as we head into worsening economic conditions. And that's revealed by this headline that we got from NPR yesterday. Americans are piling up credit card debt. And credit cards are hitting record highs, it seems like, every month. The amount of credit card debt that American consumers are racking up is just soaring exponentially. And not only that, but this is something we saw from CNBC 2 days ago. 46% of cardholders now carry debt from month to month. Now, I pay for a lot of things with credit cards, but I always pay off the debt before it accrues any interest. I pay it off before the end of the billing cycle, before the end of the month. But now, almost half of American cardholders, credit card holders, are carrying debt from month to month, and that means they're paying a lot of interest. And as the Fed has been cranking up the interest rates in their attempt to fight inflation, or at least their stated attempt to fight inflation, rates on this credit card debt have been rising as well. And so American consumers, not only are they racking up more and more credit card debt, just trying to make ends meet. Most of this debt is being spent on things like groceries. It's not being spent buying big screen TVs, expensive consumer goods. No, it's just being racked up as consumers try to make ends meet as prices are moving up significantly. I mean, in the CPI data that we got today, we saw food increasing 0.3%. So despite the fact that some consumer goods and consumer essentials like gasoline may have fallen in December, other stuff, I mean, if you try to buy eggs lately, the price of those is through the roof. And now, not only are they racking up credit card debt at a record pace, but consumers are now also paying much higher interest rates, and more of them are paying interest on this credit card debt. And I mean, credit cards are insane. I mean, they're basically usurious rates of interest because, the federal funds rate might be down somewhere around 4%, but a lot of people are paying 19, 20, 21, 22, up into the mid 20s on their credit cards. And it's incredible how difficult things are becoming for the American consumer. So I believe that any decline that we see in prices moving forward will not be due to a contraction of the money supply, but rather due to just demand destruction. Maybe that's been the Fed's plan all along. So anyway, just a quick video giving you an overview of some of the CPI data that was released today and a quick take on some of those things. I don't believe that the inflation problem is going anywhere. We may see a few more declines in the months ahead. Perhaps the Fed will slow down their pace of rate hikes, but ultimately the record high levels of debt, the demand destruction that we're seeing in the economy, the deep recession we are likely to be plunged into, ultimately I do believe that that is going to lead to further Fed intervention, because the real problem here, the massive amounts of borrowing and spending by the government, isn't slowing down at all. So don't get too complacent with your preparations for the coming economic storm, because while inflation may have declined slightly in December, I don't think we've seen the worst of this yet. Let me know what you think in the comments down below. Thanks for watching, everybody. Smart Silver Stacker out.